Thanks for tuning in to Talking Point today. I'm your host, Niraj Shah. The conversation around the last 2 or 3 months has been about how the Fed has given a backstop to the equity markets and what's happening in the US markets in terms of the Fed induced liquidity is percolating to the rest of the world as well. The question, therefore, or the talking point today, therefore, becomes what is it that large money bags are doing with their positions and stance on India in the current context relative to the world and in isolation? Well, one of the largest, or in fact, the largest category 3 AIFs in the country, Avendus. And Andrew Holland is here with us from Avendus to talk about his thoughts on what he believes the near and the medium term could have for us. Actually. Andrew, good having you. Thanks so much for joining in. Hope all is safe aside of the weekends.
Yes, all is good. And thank you for the opportunity. Thank you.
The pleasure is ours, Andrew. So just wondering, Andrew, what are your thoughts on this whole thing, the way it's played out in the last 3 months? It's now slightly over a week and 3 months that we've been in this lockdown. How have things shaped up? How have things changed from an investing perspective for you?
So obviously you said at the very beginning what's really been driving markets has been liquidity, and that continues to be the driver. It kind of gives us all very nice rose-tinted glasses because all the fundamentals, we can continue to kind of ignore. So any news, whether it's bad news, good news, becomes good news. I mean, it doesn't matter. And in the past, and we talked about this before, Niraj, liquidity-driven markets, the only thing that worries me about them is at some point there'll be something which will prick or burst that bubble. And it could be a whole host of factors. And then all the negatives that we talked about or the fundamentals that we talked about come to the fore. But for the time being, the Fed is in the driving seat. And I think today the Federal Reserve Chairman and Mnuchin are talking in front of the Senate or the Congress. And again, I'm sure they're going to be making all the right noises about we'll do whatever is needed to do, and we're going to put more money towards infrastructure spending going forward. So all of this will kind of give the market the kind of feeling that the next quarter, if we can get through that, then you're going to see the full-blown kind of V-shaped recovery from the third quarter onwards, with kind of GDP growth becoming positive sometime in 2021. So that's what the market is banking on at the moment. So that's how the narrative's changed. But there's there's very mixed results at the moment from what we're seeing in terms of data.
So, Andrew, for the fate of the Indian markets in the near term, would you believe that it will be dependent almost entirely or largely on the Fed actions, that maybe ignore the other noise, but if the Fed continues to do what it is doing, the markets continue to have a backstop?
Exactly. And, we've been slavishly following the global markets. Interesting, though, India still is one of the worst performing markets in emerging markets. And I think that's a number of factors. The big factor behind it is that unlike a lot of other markets or countries, our fiscal response has been quite poor in terms of helping out industries. So that's not been well received by foreign investors. When they look to see if the global economy turns, India is probably going to be more that U-shaped recovery now rather than a V-shaped recovery, which other countries might enjoy. Because if global growth does pick up, then obviously exporting countries within emerging markets will do a lot better.
But as one of the largest investors, are you really banking upon how the economy will shape up in order to place your bets, or are there completely different factors at play for you?
So Niraj, trying to put fundamentals in terms of saying that the market's going to go here or go there is fraught with kind of danger in liquidity-driven markets. And so what we've done is we took our experience back to 2008, 2009. And I think people sometimes forget that 2008 actually didn't see the low of the markets. It was March 2009. And what we did in that was to weave our way through was to take more of a trading view rather than a fundamental, either super bearish or super bullish view, because you can be whipsawed around. We've seen it before. Futures open up in the morning strongly, and by the evening they're down, and then we're down at the same time. So we think it's more of a trading market rather than a fundamental, view. There are some themes out there, to be played. For example, pharmaceutical, whilst it's a good defensive sector. The two new tailwinds for them is that they're probably getting pricing power back for the first time in many, many years. They just haven't. The generic companies have never had pricing power. And the second and the biggest tailwind is that once a vaccine comes through or some kind of treatment, I'm absolutely certain that Indian pharmaceutical companies are going to play a role in that in terms of manufacturing. So that's going to be the second tailwind for them. So there's a new kind of theme that you can play out within pharma, whereas before it was more defensive, which is fine, but there is a kind of a tailwind of growth going forward, which I think the market is still underappreciating at the moment.
Okay, can I ask a follow-up there, Andrew? Let's say since you started talking about themes, maybe we'll talk about themes and then talk about the other macro factors in a bit. But let's say pharma. Now, my question is, it looks very rosy. The street seems to be now turning consensus overweight here. Would you be having an allocation in your funds? And because you guys are large money managers, which is why this answer becomes important, would the weightage of pharma in your portfolios be higher than the weightage of pharma in the markets? Would you go that far?
Yeah, I think I would, and we have done in one of our funds. We have taken an overweight position in pharma. See, in terms of looking at the whole of how you invest at the moment, I'm sorry, I'm probably jumping ahead some of your questions, but
no, please do.
Is to take a nice barbell approach, because we're still in between this kind of, should we be more defensive, a little bit more aggressive? So what we've done is say we want to have that barbell. So we've got those defensive sectors with growth, which is your FMCG, your telecoms, your pharma, okay? And on the other side of that is all of those stocks and sectors which would be seen for recovery. So you've got your financials, which obviously is a large weightage anyway in your index. You've got your discretionary autos in there as well, for discretionary spending picking up. And then you've got energy and you've got industrials. So those are the sectors which will be beneficiaries of an economic turnaround as and when that comes. So having that barbell approach means you're not missing out on those sectors which will do well once the economy shows real signs of recovery.
That's interesting. You mentioned a couple of themes, both of which are at polar opposites in terms of valuations, right? Energy versus staples. Now, how do you approach these? Also, Andrew, just a follow-up to that question before even letting you answer, is your views on staples I'm asking this to you because when you were last in our studios, you were talking about how impressed you were with the commentary of some of the large staple companies as well. So how is that shaping up?
Yeah, no, I mean, listen, again, it's a growth story that's not going to go away from us. I mean, yes, the GDP growth of India is obviously going to be negative, but relatively, compared to other countries in the world, it's still one of the better ones. But it's all relative, right? But again, for consumer good companies, unless we're saying that the India growth story and consumerism is going to go away, which I don't think so, then these companies will continue to grow at the 10 to 15% per annum over the next decade. So you're going to have this continuing growth for these companies. But obviously, so let's go back to 2008, 2009 again. When you saw that in the downturn, it was those sectors, FMCG, pharma, to some extent IT at that time, which were did the best performing in terms of sectors. Coming out of that, it was your financials, industrials, energy, and discretionary spending sectors which did the best. So we don't think it's going to be any different this time around. So you can have, that's why I'm saying this barbell approach gives you that defensive kind of backdrop. The defensive kind of nature of the portfolio helps you in when that liquidity bubble bursts or gets pricked for any kind of downside that you might see in the short term.
So if you moved, Andrew, a large part of your portfolios into these themes over the last 3 or 4 months, be it pharma, or 6 months, let's say, be it pharma, be it maybe telecom and some of the others, where did you reduce exposure? Was it financials, because that is probably one large pocket, or was it something else?
So when you're trading the market, obviously you're looking for those sectors which will also underperform in the very short term. So what we did was something which we thought was quite interesting. was we identified those sectors which would benefit from staying at home. Obviously, FMCG, telecom, all of those sectors, and then looked at those sectors which would obviously have very, very strong headwinds like airlines, hotels, where spending would obviously drop very, very sharply. Financials obviously became all by itself, and then the recovery stocks, the economic recovery stocks, which includes your obviously industrials, autos, and discretionary. So all of these, it gives you can see what's happening in terms of where flows come. So as people got more optimistic, you had a bit of underperformance from your safety stocks or your stay-at-home stocks that moved more towards your banking, financial, and some of your capital good companies. So by kind of bunching them into different segments, you're able to trade through the market moves, because the market's going to move exactly how we think it should do, right? As the economy reopens, what are the beneficiaries of that? And who would be the beneficiaries? So autos comes to mind, financials come to mind, as hopes of the V-shaped recovery can start to play through. So it's a matter of looking at that and then trading your way through some of these. So there will be times when you feel that some sectors have kind of moved a little bit too high in the very short term. So those can be your hedges. So pharma sometimes has been our hedge when we felt that the banking sector might move up, because you're not going to see that kind of big move up in the pharma share prices.
Oh, okay. Actually, just a follow up there, Andrew. At least I believed so, and a lot of times I mentioned that in my trade setup as well, but I could be wrong, of course. I thought that the month of June, after a very hectic rally in the months of April and May, that the month of June saw pharma and telecom in particular consolidate a bit, despite the benefits being known and despite the earnings tailwinds being there. And they could resume the rally now with the news flow around telecom, around pharma as new drugs, the court cases, etc., all of that getting resolved. So what's your stance there? Since you're approaching a bit of a trading play, what do you do? Do you think that was a month of consolidation and the money could come back here? Would you put money back here into these things because the earnings tailwinds are strong?
Yeah, I know. I would. We continue to have strong weightings in terms of our positioning there. But you're right. And what happens is as that kind of economic kind of play comes through, then there's going to be other sectors which kind of had that catch up in the very short term, and that's what liquidity does. It makes you think, okay, L&T, for example. I'm not saying there's anything wrong with L&T, but you're going to see a big economic recovery, and therefore L&T would be a big beneficiary. Now the jury's still out whether that's going to happen. So it's going to be those shorter term kind of moves as liquidity pushes you around different sectors, and we've seen that in mid and small caps as well, as people look down to say, oh, there's value. And there probably is some value, but I think you've got to be, extremely careful on which companies you pick in the small and mid-sized companies, because it's all about cash flow for them. And if you can get companies which can, again, weave their through this kind of economic downturn, then they'll come out much stronger. But it's not a broad brush approach I would do for small and mid-cap companies.
By the way, here's a standard disclaimer. None of the examples that inadvertently come out in this conversation are recommendations. They're probably used as illustrations by our guests, and Andrew Holland is no different out there. Andrew, since you mentioned that economy opening up as well as mid and small caps, I'm wondering if those themes marry for sectors which might have some time bombs up in the next 6 months, right? The multiplex chain owners, for example, because we do not know how it will shape up, or hotels, because I think our survey with hotel companies seem to suggest that the occupancy rates are not that great right now, obviously, and marriages, gatherings, etc., are a distant theme, maybe 6 months out. So what do you do there? Because they have been bombed out, valuations might be comforting, and economy is opening up. Do you avoid them because of the potential time bombs or minefields, or do you kind of think about them?
So let me kind of give my thinking really from a global perspective, and then bring it back.
Yeah, lovely.
What we've seen in the US is obviously a reopening of a lot of the states now, and now we're seeing some lockdown or kind of I think Florida was going to open, multiplexes and cinemas over the last weekend, and then they'll stop that. They're shutting down bars and restaurants. So that has a disruptive effect. I don't think any country will do full lockdown anymore. I think that's probably gone. I think they'll look at certain states and say, okay, we'll just kind of have more restrictive measures to get us through any kind of increase in viruses. If you look at Europe and the UK, you're seeing a rapid move towards reopening. It's like we just want to get back to normal. In the UK, they're talking about the distancing rules moving from 2 meters to 1 meter, which means that that capacity for restaurants or bars or whatever is actually increased now because you can get more people in there. Now, whether that lends to a rise in cases, we'll have to wait and see. But if it doesn't, coming back to my point now about India, is it gives people confidence to do two things. One, start socializing more, but also start spending. So if I think about India at the moment, I see the number of cases rising in Mumbai and Delhi and elsewhere. So, for me, wanting to get on a plane to go to Delhi is just not going to happen. So it's about my confidence to go out there and, one, feel that it's safe, and two, that, in going out there, I'll be spending more money. And I don't think those confidence factors are there fully yet, not just in India, but I think globally. And the third factor, which I think is more important, is if this virus continues to increase and there are kind of lockdowns here and there, which are extended, then obviously job security becomes a next factor. And you're seeing an increase worldwide now of layoffs, which you hadn't seen, so far in the kind of numbers that are starting to appear. So these are things that kind of the market's ignoring because of liquidity, but is really happening. So it's all about confidence at the end of the day.
Okay. Are you and your investors, Andrew, kind of ignoring what's happening between India and China? Yesterday, Mahesh Nandurkar of Jefferies was saying that their set of investors are not even talking about it as yet. Now, my question is, are you doing the same? And if you are, is that a worrying sign? Because investors are hitherto not paying attention. And what if that intensifies, even if it doesn't lead to the eventual war-like scenario, but if it intensifies, could it put a bit of a cloud or no?
Yeah, see, we do what, $50 billion of trade with China. So it's not a small amount. So obviously it's going to have an impact. We know it's going to be autos, pharma, probably telecom. Obviously there's a lot of intermediary goods that we buy from China, which obviously keep our pricing down. Now, again, is India in a position to kind of manufacture all of that itself? The answer is no. It will take some time. But this is the opportunity India has. I think it's not just India, right? We're looking at skirmishes. But, before that, we were all talking about how companies who were reliant on China in terms of manufacturing and sourcing of goods would look to kind of relocate that outside of China going forward. And obviously India is seen as one of those countries which could be a beneficiary. But whilst we have the lowest tax rates in Asia to attract corporate companies, I still think we have to go that extra mile and roll out that red carpet in terms of land and labor to get companies. But it is a great opportunity for India. I mean, it's one of those moments you think that India could really kind of take a new lead in terms of attracting foreign direct investment, which is very good because it's more sticky in terms of flows. So I think the market is ignoring it, which they shouldn't do, because obviously it would have an impact for certain sectors like pharma and autos in the very short term, although they would have 2 to 3 months of stock, but they can't replace that. So they have to be careful. I don't think they have the manufacturing facilities yet to do it. But what we saw when we had the lockdown, companies tend to diversify very quickly. I mean, we became one of the biggest mass manufacturers globally, right? So, I mean, this is the kind of thing that India entrepreneurs can do if pushed to the wall. So hopefully they won't be pushed to the wall and we'll give them more time. But I think it's not a bad thing to reduce your dependency if you've got the ability to do so.
Okay, last two questions. I would want one view from you on what the RBI could do. And then, Andrew, I want one gut feel from you, one strong gut feel about a new upcoming thing. It could be defense, it could be back-end manufacturing, it could be all these themes that are starting to shape up in the minds of investors. But first, Andrew, a question on what do you think the Reserve Bank can do? Because thus far, we've seen that it's not been fiscal-led measures or stimulus measures, but more RBI-led. What more can the RBI do? What could the impact be of that?
So I think the RBI still has the ability to reduce rates. I still think interest rates are too high in India. Yes, there are some concerns about obviously inflation, but so far the monsoon has been ahead of expectation. So that's one worry that's being taken away as the months go on. So I do feel they have the opportunity to reduce rates by another 50 basis points. And of course, the transmission is going to be something that we'd need to see from the banks as well. I think the only other thing that the RBI can do is really kind of help the banks get through this possible restructuring of loans, because again, I don't think the private banks are going to rush out there and give lots of working capital loans if there could be a problem down the line. I'm sure PSU banks are being forced in some way to do that, but it's just kicking the can down the road unless there's giving the banks some kind of leeway to kind of not have those included in non-performing loans. But until that happens, then I think it's going to be a slow grind in terms of credit and loan growth for the banking system. So I think the RBI can help in two ways. One, reduce interest rates and give the banks some breathing space, which they really need to kind of help the companies through this working capital problem. It's a working capital problem.
Yeah, it is. Okay, let's wait and watch if the RBI is going to act more. But thus far, you have to say that even though they may have acted a bit late at times compared to what the market anticipated, but they came out all guns blazing for sure. And one last question. What's your gut feel about something that is a dark horse, something that is coming up, something that you don't necessarily have conviction on, but may or may not, but you're looking out for because it seems very interesting, or as the case may be?
So the theme that I've been looking at, and it's sort of not so easy to play in India, but it is, I'm not sure if you're in the studio or at home now, but
I'm home.
Okay. So I think the theme going forward is that will we continue to do this, work from home more often? And if so, the chair I'm sitting on, I'm sure I would want change to be a little bit better for my back and everything else. So I think we'll spend more money in the home. So home furnishings, I think, will be something which is a theme. And the other big theme are two themes which are starting to play out, which I think will come to India. Is that I'm hoping it'll come to India. Is that you'll see an increase in the number of people using bicycles. I think people will use. I know that sounds weird, but I think unless you can afford a second car, you don't really want to go in maybe a taxi or on a train, whatever it might be. You might start to use other forms of transport to get to your office or go around locally. So I think these are things which we'll see more spending going forward. And an interesting theme, actually not in India, but is outside of India, is if you wanted to buy gym equipment now in the US, there's a 3-month waiting list.
Sorry, Andrew, I missed it.
If you
what do you say?
Gym equipment in the US, if you want
to
own gym equipment, 3-month waiting list to buy.
Wow.
So what are the things we do in our home and how we want to kind of move about going forward, I think will change completely. And I think that's some of those things will play out in India too.
Yeah, it could be interesting. One hopes that in terms of the cycling front, some cities in India turn to be an Amsterdam or a London or what have you. It'd be really nice to see if that happens. Yeah. But Andrew Holland, it was a pleasure talking to you today. Thank you so much for bringing in a bit of a global context as well into this conversation. Lovely having you. Look forward to have you more often on Talking Point.
Thank you very much for the opportunity. Thank you.
Yeah, pleasure is ours. Thanks for tuning in to this edition of the Talking Point.